Welcome back to our talk at the Omaha Airport after the Berkshire Hathaway annual meeting. We just had an interesting discussion about supply and demand and how it's changing. Can you tell us a bit more about these, please?
So yeah, I think our focus is really on e-commerce. It's a big chunk of our portfolio. And I think that with the advent of the internet, it has completely reshaped, at least within the e-commerce vertical, where the moat lies within that industry. So before, if you had a unique supplier relationship, let's say you could get shelf space at Walmart, that was a durable moat for a brand or for a product. But nowadays with the internet, and also with, say, the fragmentation of the supply base, it's easier and easier to create similar products. And because a lot of consumers don't necessarily place as much value on the brand, because they can easily read reviews of a product, and they can, 5,000 Amazon reviews is going to be more valuable than, say, a brand's reputation. That moat has kind of eroded. And with the advent of the internet, the distribution methods have also become commoditized. So where you end up is the consumer side, the demand side, that is really the bottleneck for becoming successful. And in our view, that if you own the demand side in today's world, that is a early indication that you will win the market. And what's interesting also is that basically it's becoming more and more expensive to acquire customers. As I mentioned with Zoo Plus, their customer acquisition costs on platforms like Google have basically doubled in the last couple of years. And you're starting to see that across other customer acquisition channels as well. And so a lot of these companies are starting to do things within their businesses and following kind of like a super app model. So basically, if I can, for instance, have ride hailing plus a hotel platform such as Meituan has, I can use the ride hailing model to create customer habits and engagement with my platform because I'm logging into the platform at least once a day. But that creates mind share in the minds of the consumer. And so when you are looking to book a hotel, for instance, maybe you will go through Meituan. And Meituan also has, for instance, Dianping, which is a restaurant review site. Again, that creates kind of that engagement because you're constantly checking it, and food delivery as well. So I think that's an extremely interesting model. It's basically cross-subsidizing the CACs because CACs are rising. And by having that consumer mindshare, it gives them a huge moat. And what has happened in China, for instance, is that everyone thought Ctrip really owned the market because everyone looked at, say, Western case studies of, Priceline, Expedia, what have you. And Meituan came out of nowhere. They exceeded Ctrip in terms of domestic hotel bookings. And that kind of just shows you that power of that consumer habit, I think.
Stephen, you also have a case where you'd look at supply and demand. It's TripAdvisor.
So TripAdvisor is very similar to this company, and it has 3.5 billion users. It's 500 million monthly users, and it is actually not monetizing those appropriately, but it's focused actually on the trust of or building the trust of those users. So when you get to Rome or when you fly to New York, it is almost the first and only thing that you rely on to make sure that you're going to have the best trip, right? It has traditionally done a terrible job of monetizing that because it's instead, like Facebook's early days, it only focused on capturing the demand. And so Wall Street actually, it double whammies these business models because if you're not monetizing it, it's not showing up in the profits. And because it's at a quote unquote economic disadvantage versus your peers, it actually gets a discounted valuation versus your peers, even though it's in a far stronger position and is controlling of that ecosystem. It's so funny because I think, particularly post-war economics focused, most economists, when they talk about why does a firm exist, they'll talk about this sort of dichotomy between employees and shareholders. And actually, really what the internet has enabled us to do is actually go back to it, like what Adam Smith said 300 years ago, nearly, is that actually the only reason a business exists is for the customers first. And so I think not only is Silicon Valley and TMT firms showing the power of focusing on customer first, but we're, a lot of industrial, post-war, legacy mindset businesses, they'll focus on shareholders first, employees second, suppliers fourth, and then maybe the customer. And it's actually the inverse. It's really the only, and we're doing some friendly activism in Europe right now, and the company is very receiving of our message, which is actually no. It's the customer first, it's the employee second, and it's the shareholders last. And because the shareholder, the returns on equity, the returns on capital, the profit margins, that's all a result. That's actually not something you can just optimize in a financial engineering perspective. If you're and Buffett and Munger said that this weekend, if you're taking care of your customers, everything just works out in the long run. And so the result of a fantastic business model is, I think, that exact flipping the 1980s pyramid away from supply side back to demand side.
How do you see this, Fred?
I agree 100%. I think I mentioned Shopee and C Limited, and what originally attracted us to that investment was seeing, number one, their focus on customers because they localize a lot better versus their competitors. They hire the right celebrities to promote their products. And what's more important is that it flows through in terms of engagement. People use their platform 20% more per day. They, basically order 4 times a month from the platform, and baskets are extremely sticky. And so when you create something that consumers love and engage with, they're going to order from your service, and you're going to make money at the end.
I mean, I would just ask you as a TMT investor, it seems to me like a catch-22 is, so you can profit maximize or you can value maximize, but you probably can't it's very hard to do both at the same time. And so think about Trip's lack of monetization, or really actually, if you think about like the beginning of the decline of Facebook, I'm excluding Instagram from this, basically came when they started saturating the consumer with monetization. And so it is in some respects a catch-22 because customers generally respond negatively to profit optimization tactics. Think about like actually booking in some respects, and this is a personal view, so it might be controversial for Europeans to hear this, but like I think the booking experience, booking.com experience is actually fairly it's fairly unrewarding. It's hyper stimulated just to get you to convert to that booking. And it's actually it's in some respects one of the reasons why Trivago started succeeding is just because it was clean and simple, and it wasn't bombarding you with all of these sort of psychological tricks to get you to book. And so I guess I'd like to hear maybe if you have any perspectives on this catch-22 between monetizing this very strong asset that you have without actually degrading your engagement, just like Facebook has.
Yeah. So I think it depends on how you monetize, right? Yeah. So my theory and what I love to see in companies is growth through volume and growth through engagement, not growth through pricing.
Sure.
And so, for instance, platforms like WeChat are notorious for only pushing, a couple ads on their platform a day because they don't want to ruin that customer experience. Right. But because the customer experience is so good, they continue to get volumes, right? Okay. And continue to get more customers. And so you are monetizing just because you're able to show more people the same amount of ads per customer. Yeah. I think that's a much better business model, especially in the TMT or internet space, where in a lot of geographies, so for instance, I keep mentioning C Limited or Shopee, e-commerce penetration is only 3%, right? You have a long way to go before you have to maximize pricing, right? Maximize volume first, appease your customer, and drive that engagement. And they're gonna, if they stick around on your platform long enough, they're gonna order something.
Do you agree with, so very different example, very different model from a different industry, but like when we were in hindsight talking about Sergio Marchionne, who ran Fiat Chrysler with the chairman, he said it wasn't actually just long-term focus. It was actually both short and long. And so your example with WeChat on just a few ads, it almost sounds like basically moderation is the key. And so you're trying to actually balance two ends of this dichotomy so that it's not just value maximization. It's you need a profit to live another day, right? Would you agree with that? It's basically moderation.
No,
Yeah.
100%. I mean, the case with WeChat is that, Tencent makes most of their money off of gaming.
Yeah.
So you have a high margin business that is able to basically subsidize your low margin business.
Yeah.
And I mentioned Meituan earlier. They had originally trialed ride hailing because it creates that engagement, but it's not a high margin business, right? Same thing with food delivery. It's not necessarily a high margin business, but creates engagement. But the key is to then tack on a high margin business on the same platform. And that's where your monetization comes from. So I think we're going to see more and more of that, and especially in the West, as some of these Western tech companies kind of follow that same model.
Well, I mean, and that's like your margin is my opportunity. The quote that keeps going around, of course. But I think in some respects, 80% of CEOs in America actually admit they will actually not make an investment if it's going to impact next quarter's earnings. And so maybe we do see it more and more. But the history of owner operators is generally not profit maximization. It's faster revenue growth. So we're going to come out with a white paper actually later this year. I'm sure we can share it with Value Deck as well. And all owner operators have almost half the profit margins of the index, but twice as fast revenue growth. And so it's that focus on it's focus on volumes. It's focus on continuing to scale, and actually hiring more employees and spending more on R&D and spending more on marketing. And that is actually in a very just to bring it back to Berkshire, I mean, actually, that has been Berkshire's strategy, particularly with Geico. It's always deferred gratification, which was why I was somewhat surprised when Buffett was asked about deferred gratification at the meeting this weekend, and he actually seemed to back off a little bit of deferred gratification as sort of like a catch-all, and so it kind of made me think about it's sort of back to this moderation argument But unfortunately, right now, Wall Street is generally having a gun to every CEO's head. Just make the quarter and just optimize this year's profit without regard to the next 5 years. And so if 80% of people are doing that, all you have to do is the opposite, and you're probably going to do quite well.
I think the one way to maybe balance this is, are you going to monetize your customer or are you going to monetize your supplier base, right? And if suppliers are becoming less powerful and more fragmented, in the case of WeChat, for instance, I'm just throwing this out hypothetically, but if you're only going to push, say, 2 ads a day, those ads become more valuable, right? And you're going to be able to charge your suppliers more. Yeah. And that doesn't hurt that customer experience. So it really depends on what method you choose to kind of monetize that as well.
That's clever, yeah.
Yeah.
So you had I heard some certain critique about the American stock market and the stock market culture in your.
We're destroying our businesses. I mean, when you're optimizing for the next quarter's earnings, the white paper we're coming out shows this, but there's so many other studies that show this. If you're just even playing the quarterly, if you're merely giving quarterly guidance, you've already lost, because the one of the best books of the last few years is Measure What Matters, whatever, and it comes off of this phrase that like what you measure or gets is the only thing that ends up getting focused on in the organization, and unfortunately, at least 80% of businesses in America are being managed to make a quarter. And actually, what it does is and actually even I think it was like 15% of CEOs have actually admitted that they will actually change their accounting to actually hit the quarter. Like they'd pull forward a sale illegally to actually hit the quarterly guidance, right? So what that does is it destroys, your mission is no longer serving a customer, and it destroys employee morale, because you are no longer part of a mission. All you are is a monthly quota, and you have a gun to your head, and you're gone if you don't hit this quota, right? So it's reducing everything down to transactional, which no person wants to work for that company, which is why 60% of Americans report that they're unengaged at work, completely disengaged, right? So this quarterly profit optimization is actually destroying the business, and is the raison d'etre why I've decided I have to write a book to try to change this mindset that, basically young kids that are our age go sit with a CEO of 60 years, and 90% of the questions revolve around how are you going to make the quarter and what are you going to do to deliver higher profit margins? And it is the opposite advice that you want to take. One of my favorite quotes from Munger this weekend, when he was asked why can't they be more like ESG, like Larry Fink and BlackRock, who I think is BlackRock's destroying corporate governance in America. And Charlie said, these people want us to do best practices. And he's just like, when you think of, he's like, it's actually all of these best practices that consultants would have you believe is literally the opposite of what a best practice is. And he says, so I'm quite happy to not do any of their best practices. And it was, it was sort of one of those like Superman moments that I was just like, yes, thank you for saying this. But of course they say it a lot more delicately and gentlemanly, and I'm just willing to call people out.
Do you find a better model in Europe?
Absolutely. I mean, there's more European, in Europe, there's more family controlled businesses. The amount of businesses that own, so in Europe, you'll have families that will own 20% or more of a company, and that's really quite common. In America, the way that Silicon Valley has approached it is they'll do dual share classes. So we're also looking at dual share classes, which have very similar attributes. By the way, back to best practices on corporate governance, all the proxy advisory firms advise against dual share class companies, even though dual share class companies, when you actually behave just like family controlled businesses, they're not profit maximizing, they're value maximizing. And since 1974, which is the furthest back our data goes, you've outperformed the market by 100x by being in dual share class or owner operators. And there are more of those in Europe. Where Europe is really missing is a tech focus, right? So there's good businesses, there's good industrial businesses, there's luxury businesses, there's consumer products businesses. There are a lot of higher quality businesses in Europe, but there is almost no TMT, so to speak. And so, but they focus on what they do well. Think about France and Italy are 2% of the world's population, but they're probably over 50% of the world of design and fashion and luxury and cars and et cetera, right? So they focused on their strengths. But yes, I'm sorry, Europe is much more family operated, which is they want to hire the best people who are more expensive and so lower profits.
Actually, I want to ask a question about that in terms of, you talked about how management kind of needs to change their thinking around, short-term versus long-term profit maximization. I think another piece of that puzzle is the shareholder base, right? Or the way that investors act.
It's the only important thing, yes.
Yeah, it's almost like a virtuous cycle, right? If you have a shareholder base and shareholders or investors are becoming more and more short-term oriented.
Absolutely.
And so you have to change that mentality because CEOs are obviously.
This is why I'm writing the right paper that leads to the book is I need to prove that it's in investors' best interest. And the annual outperformance is 2 to 3 times, depending upon the year. So it's in your best interest to actually, because I think a lot of American firms would reject a notion of a company maybe even suspending. People hate it when quarterly guidance is suspended because it's seen as an oh shit moment. And so and not only that, exactly to your point, most of these CEOs can't actually build for a medium-term plan because they will just get fired and buy, a 5% shareholder. Essentially, and the next person is just going to be just as bad because you if the shareholder behavior does not change, then the corporate behavior cannot change. But I think a good part of this you need to have boards with temerity. You need corporate governance that is much more owner focused. And in this country and in Europe, I actually just went on the board of a Portuguese company, and I'm seen as a detriment to the company because I'm not independent because we own 7.5% of the company. Meanwhile, I am the only one in the room that cares about the long-term value of that business. And so it's so this consultant culture that we have, and with the machines taking over corporate governance in this country, machines being ETFs. They're appointing board members that are focused on liability minimization because they just don't want to do something that basically gets you fired, essentially. That's not how you create value. So we have, I think, a potential for active managers that support owner-operators and longer-term focused businesses. And again, it's not long-term at the expense of short-term. You've got to manage for both. But I think the robotization of markets is actually going to make active management better to the extent that we can behave better and behave as shareholders that actually deserve the managements that we get. You get what you deserve, right? And so for sure, behavior needs to change. And I would say we're two guys raising funds, which is quite difficult in these days. And the easiest way to raise $1 billion is to just go market neutral and focus on the next 3 weeks. And so unfortunately it's not even just fund managers, it actually has to come from the endowments allocator side of the universe as well, that are going towards 3-week time horizons and these market neutral funds that if you're down 3%, you get blown out of the pod. I mean, and this is actually translating into this behavior is actually is exactly what our politics has become. I mean, this is actually a deep systemic problem, and that's why I was very surprised, negatively surprised, but whatever, that's Buffett, that he watered down the importance of deferred gratification, because I think in this country we have the opposite problem. There's none. It's only short-term maximization, which again, I think just deteriorates everything. And it's happening in our government too.
Nothing to add.
Yeah, me too. So thank you very much for this great and interesting interview, and have a good travel back.
Thank you.
Thanks.